still in rally mode with the S&P and the Nasdaq both recovering all of Wednesday's losses. And here to look at the next key level to watch, we bring in our friend Stephen Grasso, CNBC Fast Money trader and director of institutional sales with Stuart Frankel. Stevie, how are you?
Hey, Bill. How are you?
What levels are you watching here?
So let's take a look at back on the recent sell-off that we've seen with the overall market, specifically this area right here. So I'm going to talk Fibonacci retracements. Right here, we sell off in the overall market. We bounce back to the 50 and the 618 retracement. I know it sounds a little wonky. It's not that wonky. You retrace half the move that you're moving up. It failed right at that level. This is the problem, is that once it failed, you traded down further from that initial point of failure. What's going on now is the same sort of action here. We've traded down to this level, rallied back, and you wind up hitting that resistance again, specifically in the S&P, 29.25 to 29.50. That's where we are right now. So if we cross over that, it's extremely bullish. Then it opens up back to the levels of 30.27 to break out again to new all-time highs. But it's to a large extent, it all hinges on this level right now. Let's call it 29.50. That's where you want to breach across that, or else this is all for naught, and we're going to wind up trading straight back down again and possibly testing that 200-day moving average at 2,800. So keep in mind, 29.25, we're having a rebound rally. It was an oversold market. Now 29.50 is where you really need to break out before you get sucked back into buying the market. I would not be a buyer here. I'd be a seller right at these levels for the next 25 handles higher. You could always rebuy it higher with all-time new highs being made, but I would wait, sit on your hands if you're a buyer.
Are you getting any volume with any of these moves here?
You have to remember, when the last 2 weeks of the summer, so you have a lot of people not sitting at their desks.
Right.
The technicals are reinforced by bloated volume, but they don't necessarily need it. They validate it, they confirm the move, but we don't need the volume. We can just get the levels, and it gives us a roadmap to guide our ship or our investment thesis.
All right.
Why do you think we bounce back, Steve? And I asked you this because I'm just trying to figure out if the reason for the bounce back, erasing most of Wednesday's losses, is for real, or if the markets are just simply looking ahead to the possibility of German fiscal stimulus as well as a dovish speech from Powell on Friday.
Right. I think, to your point, markets are fickle. They bounce back because we were in an oversold state. You have, to Bill's point, light liquidity, so you never short a dull market, never fight the Fed. You have two of those things going on in the last 2 weeks of the summer. But I do think it's more of a case of guys are reaching and traders are reaching for safety trades. And you look at what's happening in the 10-year. You look at what's happening in utilities. You look at what's happening in REITs. This is not a high convicted market to go higher from here. I think it's just a rebound effect, just a bounce point.
Steve Grasso. Good to see you, Steve. Thanks.
Good to see you guys.